Okay, dear students, we'll be starting in a short while. Just bear with it and ask the other students to join the meeting immediately. It's very important. It's related to your projects. It's related to your marks, which will be given in this particular semester. So make it a point to attend. Dear students, make it a point to attend this. It's very important. Just communicate with your friends also. We'll be starting slowly. We'll be starting shortly. The speaker is joining within the next 5 minutes. Welcome, Nikhil sir.
Thank you, sir. I
Good
think
morning.
I'm being audible.
Ye- Yes, yes, yes. Sir, you're audible. You would like to share the PPT also, no, sir?
Yes, yes, sir.
One sec.
Do I have sharing access?
You can. I'll ask them to give you the sharing access.
Yes. I think it is visible.
Yes, sir. Yes, sir. It's visible.
Okay, great, great.
Uh-huh. Uh, Students, we are starting with this particular very interesting lecture. Okay, it's our privilege to have amongst ourselves the HOD of Mulund College of Commerce, HOD of Accountancy Department, Mulund College of Commerce, Professor Nikhil Karkhanis, sir. I'll just give a brief introduction of sir before we start with this lecture. Sir, we are really honored to have you on this particular occasion. Students, Nikhil sir is the head of the department of Mulund College of Commerce. He was a district coordinator of NSS. Then he was a board of studies member of our accountancy department, University of Mumbai. And till the year 2019, he is the board of studies member of Somaya College right now also. And he has got many laurels to his credit. Due to the paucity of time, I'm not highlighting all the laurels. So we are really fortunate to have Sir amongst us. And Sir is going to enlighten you about the various aspects of this management accounting. And students, this will be your project also. This will be your class test also. This will be everything. At the end of the lecture, we'll be sharing the Google form for which you have to attempt. So please pay attention to the lecture very nicely. And based on your performance in this lecture, we will be awarding marks to you also. Thank you so much, sir. And the dice is all yours.
Thank you, sir. I hope I'm perfectly audible to the students because
Yes,
it is on YouTube live. I will not be able to interact with them. I understand, but I'm sure if they would want to get in touch with me, contact details will be shared at the end.
yes,
This I'm sure is like a revisionary lecture for all of you. So you are already aware what management accounting is, and so we are just going to go through few concepts, few important concepts in a shortest possible manner of time, so that this will serve as a good booster for all of you when you are attending your test. I will also provide you with some detailed MCQs, and my presentation and PDFs will be shared with your teachers. So I'm sure you will get access to those as well. Uh, so we are going to discuss few concepts of management accounting. Uh, we know how the process of accounting works. We start with an identifying a simple transaction, and it then it goes through process of bookkeeping through recording into journals and ledgers. Lastly, we prepare trial balance, and end goal is preparation of financial statements. So till now, I think this is something that our journey has been. Whenever we talk about accountancy, this is what we understand and this is what we mean. So where are we currently at? So bookkeeping is a primary way in which we are going to record the transactions. Further, in accountancy, we classify transactions and a lot of other analytical aspects of accounting up to the preparation of financial statements is taken care of by accountancy. where does management accounting comes into? So management accounting comes into exactly where your accounting stops. Once you have prepared your balance sheet, once you have prepared your P&L, once you have prepared your cash flow statement. So when we talk about financial statements, we understand that it is a balance sheet, it is a profit and loss statement, it is a cash flow statement, statement of changes in equity, and all other notes, schedules, annexures, all of them form part of your financial statements. So having said that, where does our management accounting come? So management accounting comes exactly where our financial statements end. So after your financial statements are prepared, we need to analyze them. We need to understand how our financial results have affected our business. So in the same manner, when you are watching Shark Tank and the shark in Shark Tank, the sharks ask the question, so what is EBITDA and what is PAT? All these things we are going to answer today, and that is the work of management accounting. That is what management accounting tries to tell you, that it's not just about numbers and how to make sense of those numbers, how to take business decisions based on those numbers, and that is the task of management accounting. So we are aware why do we need financial statements, right? To understand our financial position and performance, but most importantly to enable us to take a business decision. So the role of financial statements is just not having assets and liabilities and being happy that our balance sheet is tallied, but to be able to take business decisions. Valuation of business is based on your financial statements, and as I said, we are all of us are fans of Shark Tank, and when they value the business, what do they want? They would want the top line, the sales, they would want the bottom line, that is the EBITDA, the PAT. So that is how they will decide the valuation of business. The comparability of financial results of not only from the previous years of our own company, but as well as to the other peers. So for example, if let's say I'm a software company, I would want to know what Wipro is doing, how Infy is doing, how TCS is doing. That is how I will come to know whether my performance is good or bad. So as you know, if you remember, दुख तब होता है कि फ्रेंड को ज्यादा मार्क्स मिलते हैं. So the same way, दुख तब होगा जब बाजू वाला कंपनी अपने से ज्यादा प्रॉफिट कमाएगा. So that the comparability is taken care of by the financial statements. Consistent accounting policies can be applied, and the use of consistent accounting policies uh, can be facilitated through financial statements, because then the comparability for financial statements will be taken care of. Periodical analysis from year to year, month to month, quarter to quarter, but more importantly, and nowadays, each day's activity matters, and that is the task of your financial statements. So, who are the users of financial statements? Predominantly, the owners, whom we also call as the shareholders, the management who runs the business, investors who have invested in business, lenders who have given you a loan, or whom you have approached to avail loan. Employees would want to know whether they are getting salaries based on what company is earning. If company is earning good, then they would want better bonus. Government will be very keen to know about your financial statements, because ultimately the tax that you are paying is based on the profit in your profit and loss account, your income statement. Customers sometimes, not always, sometimes they may be interested in your financial statements, but predominantly your owners, management, investors, lenders, government, and employees are the key people, key personnel, key persons who would want to know how you have how your financial statements will create a difference. Uh, Moving on to our focus of the day. Now, tallying balance sheet is an achievement for us, and all of us are very happy when the balance sheet gets tallied. But my dear friends, in management accounting, balance sheet, if balance sheet is tallied, that is where your work will start. In management accounting, your first job, your first task will not be to tally the balance sheet. The tallied balance sheet already will be given to you by the accountants. Your job is to go one step ahead. Your job is of an analytical purpose. So you will have to prepare various reports. You will have to analyze the balance sheet and P&L. After analysis of financial statements, you will come to some business decisions. So tallying balance sheet is no longer our primary goal. That is something we always assume that is already done, already happened. So what we want to do is we want to go a step ahead. So now when in management accounting, when we are going to look at financial statements which are already prepared, so what is that we are going to do? We are going to analyze them. We are going to apply certain tools and techniques on them. We are trying to understand if the data that is presented to us, whether that data makes sense. And to be able to do this, and this is very important for you to understand, please remember, preparing financial statements is a mandatory thing. It is a compulsory aspect of a business that I should have my balance sheet, my P&L, my financial statements. Government agencies would require it, my investors would require it, my shareholders would require it. But it is not important, it is not mandatory that I must have my management accounting reports made public, because that is something which depends upon business to business. There will not be any fixed report that you have to fill in to come up with business analysis based on management accounting. There will not be any professional who will be assigned to complete these reports. So that is where, if you are aware, nowadays the fields like data analytics and data science are coming to the fore. Now that is where the management accounting is. You are going to make sense of the data, and for that there is no fixed report that you have to fill. It is not mandatory that you have to do management accounting. It is up to you to use your business acumen, to use your talent, and to make the sense of data and to be able to take business decisions. I will give same amount of money to two students. 1 लाख रुपया मिल जाएगा एक स्टूडेंट को, 1 लाख रुपया मिल जाएगा दूसरे स्टूडेंट को, and I will tell them do business with this 1 lakh. Both of them may not succeed. One of them will succeed and one of them may not succeed. Why? Because they have not been able to make sense of the information that they have. To be able to convert information into money, into business decisions, into profit, that is the role of management accounting. So what we will do is we will study one of the tools of management accounting, what we call it as a ratio analysis, right? So what we will do, we will look at just 1 minute. Yeah, this here. Okay. So ratio analysis is an important tool to make sense of a lot of information that we have. So all of us are aware, in accounting, in maths, we see a lot of numbers, and sometimes those numbers confuse us. We see lines and lines of numbers, and we sometimes feel, ये इतना सारा numbers क्यों है, मैं तो confuse हो रहा हूँ. That is where ratio analysis steps in. Ratio analysis helps you to come up with a simpler solution when you have a lot of numbers around you. So what essentially happens with ratio analysis? It is simply tries to have a relationship between two or more numbers, as you can say. So when there are a lot of numbers, what you try to do is you try to make some meaningful connection out of those numbers, and that connection will be helpful for us to be able to take some business decision. So if I in isolation tell you that profit of one company is 1 crore, you will not be able to make much sense of that information apart from understanding that yes, 1 crore seems like a big number, but I want to be able to compare that 1 crore with a lot of other information. So that is why my ratio analysis will be helpful. It will help me to know my financial strengths and weakness. It will try to tell me my operating efficiency. It will try to try to make me compare my activities and my performance from last year, from current year. It will help me formulate my business plan, and most importantly, it will help me to optimize my capital structure. If I invested 1 lakh, I want best possible return. And how do I get best possible returns? I should be able to take quick business decision making. I should be able to check performance of my own company. I should be able to check performance of other companies. I should be able to understand मेरे बैंक में कितना बैलेंस है और वो बैलेंस के साथ मैं क्या बिजनेस डिसीजन ले सकता हूँ. आई शुड बी एबल टू अंडरस्टैंड कि अगर मैंने एक चीज 10 रुपए में बेचा है, मैंने इसके ऊपर प्रॉफिट कितना कमाया है. ये अगर मैं सेम चीज 12 रुपए में बेचूंगा, if someone will be able to purchase it for 12, thereby I will earn more amount of profit, or if I charge more, my demand will decrease. All these important decisions can be taken if we have solid grip and solid understanding of ratio analysis. Okay, so naturally there will be some small limitations of it, right? You have to get the good data so that you will be able to take decision correctly. What if the data that you have received, that data is itself faulty, right? Ratio analysis, to a large extent, it involves comparing the past performance, and that in business what matters not what happened 5 years back, 10 years back, yesterday, what happens today, and based on that what decision you take for tomorrow, right? uh, and again, it's just a tool. What you do with that tool, that is most important. You should be able to use that tool effectively. You should be able to use your experience, wisdom and knowledge, so that you will be able to understand a meaningful decision. So I can give you a pen of 10,000 rupees, and I will tell you, go write exam without studying. That will not help you. What helps is a prior efforts taken, which will give you good results. So if we are using ratio analysis correctly, then we will be able to understand it in a better manner, and we will be able to take decisions which will be helpful for us, right? So general classification of ratios is, the ratios can be balance sheet ratios, revenue statement ratios, and mix of balance sheet and revenue, that is mixed ratios or composite ratios. This classification, you can say largely is based on financial statements, the availability of data. The other is more, functional classification. So for example, you have what is known as liquidity ratios, either short-term liquidity ratios or long-term liquidity ratios. Then we have turnover ratios, and we have profitability ratios. So like these are a lot of ratios that we are available for us to take certain decisions. I'm sure you are aware about some of these ratios, so I'm not going to get into each and every each and every ratio. We are not going to discuss. You will get the entire PDF through your teachers, so you can explore for yourself, and I think that discovery will be much better for you. So let me take some select ratios for the discussion. In balance sheet ratios, we have these prominent ratios, and the one of the fundamental ratios is the current ratio. Now, current ratio is important because it tells you the liquidity position of the business. It is the relationship between your current assets and current liabilities. I'm sure you are aware, if I want to calculate my working capital is current assets minus current liabilities, right? So working capital gives me how much current assets I have over my current liabilities. This ratio gives us a comparative analysis, right? So what it does, it tries to understand how many current assets I have, how many current liabilities do I have. So once I have a ratio, I am in a position to understand what is my short-term liquidity position. The standard ratio is 2:1. That is to say, if I have let's say current assets of 10,000, I should have current liabilities of 5,000. Naturally, a standard ratio is something that you would want to attain, but not necessarily is possible for you. You strive to attain that ratio, right? Then something which is similar to current ratio But before we go to the liquid ratio, please understand these components of current ratio, what constitutes current assets and what constitutes current liability, right? Uh, Under current assets, we are aware cash in hand, cash at bank. So basically cash, the most liquid form of asset. Marketable securities, short-term securities, securities that I hold so that I will be able to sell them off at a very short notice, right? Bills receivable and debtors, we call it them as accounts receivables or simply receivables. Inventories, or what we call it as stock. For inventory, we are aware that the components are raw material, work in progress, and finished goods. Prepaid expenses and advances, if so at all, given to someone. Under current liabilities, we are aware that we have payables, payables for goods. Usually, we call them as sundry creditors. Some of sundry creditors then they get converted into bills payable. So we are aware the efficacy of bills of exchange, that is the negotiable instruments. Then there are outstanding expenses. Together these, so creditors for goods and creditors for expenses, they are usually what is payable by the business. Then we have short term advances. Tax payable is a liability which we owe towards government. Dividend payable is something, let's say dividend is declared, approved, but not yet paid to the to our shareholders. And most important and crucial aspect of your current liabilities is your bank overdraft or cash credit, as the case may be, which is sanctioned by your banker, right? Now why we should understand all these different different aspects of current assets and current liabilities, because when we come to the ratio which is, you can say, subset of current ratio. करंट रेशो अगर बड़ा भाई है तो लिक्विड रेशो उसका छोटा भाई है. सो लिक्विड रेशो इज क्विक एसेट्स अपॉन क्विक लायबिलिटीज. नाउ दिस इज अ मेजर ऑफ इमीडिएट शॉर्ट टर्म ऑब्लिगेशन. तो अगर करंट रेशो हम बोलेंगे कि ये शॉर्ट टर्म है, शॉर्ट टर्म मतलब वी विल स्टिल लुक एट वन ऑपरेटिंग साइकिल, मे बी a month's time, couple of months time, maybe 2 to 3 months. But liquid ratio, acid test ratio or quick ratio, this is a measure of our immediate liquidity. अगर आज के आज अपने पास कोई सब पैसा मांगने आएगा, if our creditor wants to be paid immediately right now, then what is the position of our business? That is where our quick acid test or liquid ratio comes into. Now why studying current ratio is important? Because as I said, our liquid ratio is derived out of our current ratio. So to be able to understand quick ratio, we should know what are quick assets and quick liabilities. So what are quick assets? Take your current assets, reduce them, reduce from them our closing stock and our prepaid expenses. Take your quick liabilities and for quick liabilities, take your current assets and reduce their from your bank overdraft. Naturally, your question in your mind should be, ये हम लोग reduce क्यों कर रहे हैं? Why are we reducing these elements from current assets and current liabilities? Now, if you think about it, the answer is very simple. When it comes to my closing stock, it is something which I cannot sell immediately. Now, maybe a paradoxical answer. Am I audible? Hello, hello.
Yes, sir. Yes, sir. You are audible.
Okay. Yeah, thank you. So this might be a paradoxical question, because you have closing stock inventory, that is something you wish to sell, but the stock that I on my hand right now is something I have not been able to sell it off immediately. If I would have been able to sell it off, it would not have remained in my stock. So the fact that it is still lying with me indicates that I am not able to convert into cash immediately. Similarly, prepaid expenses are something that I have only paid it to someone else. That means It is something for which I cannot get benefit immediately. So that is why when it comes to quick assets, all that I will be left with, then by extension is my cash, my short-term investments, and my debtors. Again, if you look at quick liabilities, you will realize that all other liabilities, be it bills payable, sundry creditors, tax payable, they can be asked to be paid immediately. But for bank overdraft, I have already entered into an agreement with the bank that it will be available for some few months or a year, or it can be what is known as rollover facility. So I don't have any immediate focus to pay it back. So that is why the test here is, what is quick asset which can be realized immediately? What is quick liability? What are quick liabilities? Something which will have to be paid immediately, right? So with this logic, what we will do is we will try to calculate quick ratio, quick assets upon quick liabilities. The standard ratio is to 1:1. That is to say, if I have to pay something on an urgent basis, immediate basis, what I have to do? I have to collect money from my quick assets and immediately pay off my quick liabilities, right? It is measure of my immediate short-term obligations. Okay. Similarly, we have stock to working capital ratio. It tries to analyze our stock inventories in relation to our total working capital requirement. I will just go through some ratios quickly, so that when later on you are revising, it will be helpful. Another important ratio is debt equity ratio. It tries to understand how much loans you have borrowed, against that how much funds uh, your own owners, your proprietors, your shareholders have invested. So typically this is also the standard ratio is 2:1. So current ratio, debt equity ratio, standard ratio remains the same, right? Proprietary ratio tries to arrive at a percentage of how much total assets are out of shareholders funds. So to purchase my total assets, how much amount my shareholders, the owners, have invested into the business. Coming to income statement ratios, simply mean that we are extracting information out of income statement, that is the profit and loss statement. So you can pick up any kind of information from your profit and loss statement, and then you can you can calculate those ratios. And then let us see few ratios and try to see how our income statement ratios, they try to give us some insight. So let us look at see multiple I think it switched off and it got switched on or something. Okay. Okay, are we still there?
Yes, sir.
Okay, thank you. Yeah.
Yeah,
So
Yes, sir. Yes.
gross profit is a fundamental ratio to understand a business. Gross profit upon net sales into 100. Whenever we say sales, we always mean net sales. That is, we are reduced the returns by our customers. If we consider it gross sales, then naturally it will give us the wrong parameter to consider our sales. Now, why do we say it is the fundamental tool to understand business? So, in any business, you ask a business person, what is your margin? What is your gross profit? More or less, for all the businesses, that margin remains more or less the same. It will not happen that a business in one particular sector is having gross profit of 20%. Another business in the same sector, similar kind of business, is earning 3 times, 4 times. Maybe in short term, what we call as super profit can be earned, but in long term, gross profit remains more or less similar for similar kind of businesses, right? Gross profit ratio indicates your efficiency as far as your manufacturing, your distribution is concerned, right? So your efficiency to produce the goods, the efficiency of your core business can be understood by the gross profit. Many times, this is also known as gross margin ratio. And if you talk to any normal businessman, he may not understand, gross profit ratio. You simply ask him, sir, आपका margin क्या है? Madam, आपका margin क्या है business में? And then immediately, without any calculation, they will give you perfect number. That is how important gross profit is. So when gross profit ratio is. So please remember, gross profit ratio, very important tool to understand business, to understand the profitability of business. Whenever you are trying to understand profitability, gross profit ratio is the first ratio that you will always check. Okay. However, gross profit ratio, as I said, is only it only concerns gross profit. We are aware that the final profitability is not the gross profit ratio. The final profitability of the business depends upon what is known as your net profit ratio. Before we go to net profit ratio, we can also calculate what is known as operating ratio. Operating ratio simply tells us at operational level, that is cost of goods sold plus operating expenses. So this is at a one level above gross profit in terms of analysis, but still it has not reached the final conclusion, that is to say analysis of net profit. Similarly, we can calculate individual expenses ratio. If I just want to compare that, let's say how much is how much expenses, how many expenses for salaries, how much expenses, let's say for printing station, try to identify expenses. So net profit ratio can be, we can say the final profitability ratio be considered. Now it can be calculated in two manners. One can be net profit before tax upon net sales into 100, and the number that we always look at, which is PAT. So profit after tax net profit after tax divided by net sales into 100. Ideally, when we say net profit ratio, we always mean and we always intend it to be net profit after tax profit. That is what we always compare. Now, this ratio is important because it considers all the expenses of business. So, after having considered, deducted all expenses, after having even paid tax to the government, what we calculate is net profit ratio, popularly known as PAT ratio, profit after tax ratio. This indicates what is your efficiency as a business organization, because it not only considers your business income, it also considers what is known as your non-operating income or non-business income. Naturally, it is not at a large, it's not a large number, non-operating income, but still in certain cases it becomes substantial. And more importantly, it considers all and every revenue streams of the business after the tax obligations. Finally, how much the business has earned for its shareholders can be known by our net profit ratio. Okay, very important measure. So what we will do is we will now quickly look at few ratios who look into efficiency of capital, if we can say. So you will see a lot of ratios later on. You can go through them. Next slide is not moving. I'm not sure. Is it moving? Okay. So as I said that we will look into few ratios which will talk about efficiency of capital. And first and foremost important ratio in understanding our business is what is known as return on capital employed. Now, please understand, when we talk about capital employed in terms of business, when we talk about capital employed in terms of business, capital is not a narrow concept here. Here we mean all the funds which are going to be there in for long term in the business. Now, naturally, it includes share capital, reserves and surplus, but more importantly, it also includes long term borrowing. When I want to understand how many resources I have deployed in the business, so that is why, if you are aware about the vertical financial statement, in vertical financial statement we don't say total of liability side. What we say is the total of capital employed, because what we want to know is how many funds the business has invested and what is the total return out of it. So that is why return on capital employed is an exceptional tool. It tells you how much long-term funds the business has invested and how much returns it has generated. Naturally, the measure for it can be profit before interest and tax. Now, why that is so? That is because in capital employed, we are also considering long-term borrowing. And what is the return that we pay to long-term borrowing? That is interest. So that is why when we are going to compare our performance, we are going to look at profit before interest and tax. We are going to divide it by capital employed, share capital, reserves plus you are going in the ratios, it means you are going to calculate it. Whenever we are going to analyze a business, this is one of the fundamental ratios as an analysis and as an analyst you have to always look at. Okay, so moving on to subsets of this ratio. So now what we are doing is we are starting from the top. we are saying how much business has earned. Now we are comparing that returns with how much shareholders have earned. So naturally, whatever business has earned, if I reduce my interest from it, I reduce tax from it, whatever is left is my profit available to equity shareholders or to my shareholders. So my return on proprietors funds is my returns to equity as well as preference shareholders, right? So that is net profit after interest and tax, but before dividend. Net profit after interest and tax, but before payment of dividend. And I have my proprietors funds. In proprietor funds, I have equity and preference shares, my reserves, and naturally I will be reducing my fictitious assets therefrom, right? It is the indicator of how much profit is generated by the business for shareholders. Please remember and understand, the shareholders may not get entire amount. This is what has been earned for them. It is not necessarily what they have actually received, right? If I go one level deeper into the analysis, I can calculate returns to my equity share on equity share capital. So I can find out how much profit is left for equity shareholders. From net profit after tax, I will reduce my preference dividend, and I will compare that with my equity share capital, and I will try to understand how much returns are available for my equity share capital, equity shareholders. Now this is a very important tool, one of the most important aspects, earning per share, EPS. Usually when you are discussing performance of companies, uh, return on capital employed or return on proprietors funds, equity shareholders funds, this is something which is done at a deeper level. If I want to quickly understand the performance of a company, I will simply ask EPS kya hai. Now what is EPS? EPS will simply tell me that per equity share, how much profit the company has generated. Net profit after tax and preference dividend upon my number of equity shares. This will tell me if I have 5 lakh shares issued, what I have earned on the each share. एकदम simple measure, एकदम quick measure. I simply want to know कितना कमाया है. Quick measure, 10 rupees, 20 rupees, 30 rupees, 40 rupees per share. Because the final unit of owning company is that last share. The share capital is divided into per unit, and that is each share is the final unit. So this is my definitive answer. If I invested in one share, my company is earning 50 rupees per share. That's it. This is usually used to quickly understand whether company is earning something which can be said, which can be compared with its peers or not. So very important ratio. But this is what the company has earned for equity shareholders. Still, equity shareholders have actually not received their dividend. This is what helps us in understanding what equity shareholders have actually received. So how do we calculate it? We calculate it in two ways. One is we say that how much total dividend given to equity shareholders. Upon that, we divide that by profit available to equity shareholders multiplied by 100. So that gives me a percentage wise. Other way of understanding my dividend payout is simply how much dividend per equity share I have declared, I have given upon earning per share. See, just we studied EPS. EPS is what we have actually earned. DPS is actually what equity shareholders have received. So dividend actual received, earnings per share, actual total earned. On that basis also I can calculate my DPS, dividend payout ratio. Okay. Now this is what people will look at when they want to understand, if I'm investing in a company, I will be purchasing shares. On the shares, what is the usual dividend that I usually get, right? So earning per share, how much my company has earned. Dividend per share will tell me how much dividend I have actually received. Okay. So these are some of the analytical tools in the form of ratio analysis that are available. One of the most important tools, sorry, एक आगे चला गया. One of the most important tools to understand whether a company is investable or not is called as PE ratio, price earning ratio. Now this is an important ratio because it shows whether the market, the share market, the investors, the potential shareholders, how much they are, how much bullish, how much positive they are on the growth of your company. So let us first understand how it is calculated, and let us then try to understand how P ratio is important. P ratio is simply the share price, current share price, divided by earning per share, EPS. Now what it simply tries to do is it tries to tell you that if I am investing in the shares, if I am investing in the shares of the company, how many number of times is the earning per share? The ratio is expressed in number of times. If the answer, let's say, comes to 40, if the answer, let's say, comes to 40, what does this indicate? It indicates that, let's say, my share price is 40, earning per share is 1. That means my share price is currently 40 times my earning per share. This indicates the confidence. This indicates the confidence of investors in the company. Now this will, now naturally you will think, sir, that means higher P ratio is good for company. Company has more confidence of investors. Yes, ideally, theoretically, that is correct. But that holds true only to a certain level. It also holds true as far as the comparison with your peers. It cannot be that you are in the same sector, your company in the same sector, your P ratio is 100, your competitor's P ratio is 20. At one level, you will say, sir, that means market is appreciating me 5 times more than me. That is not how it works. Higher P ratio may also indicate that your share price has gone out of control. Your share price is inflated. So when we are comparing P ratio, we normally compare it in relationship with the peers of the industry. So for example, अगर मुझे ONGC का compare करने का है, I will look at, let's say, Reliance Industries Limited. I want to look at P ratio of SBI. Maybe I will look at a P ratio of a banking company, let's say ICICI or HDFC, as the case may be. I want to look at Maruti Suzuki ka P ratio. So I will maybe look at Tata Motors ka P ratio, and I will get a sense of what is the confidence of market in this sector, right? So these are various tools of ratio analysis which are available to us. I'm sure we can discuss much more, but I understand that you have to appear for a test. and the discussion that we have made, I'm sure will be helpful for you in solving your test. Uh, I want to stop only here itself, unless there is something that uh, maybe sir wants to discuss with you, or there is specific points that want to you want me to uh, explain to you much more. But I think this much discussion is more than sufficient for you, for your appearing of your test, and as well as your basic understanding of how management accounting is, and how further uh, ratio analysis will help you to make sense of financial information.
It was really a wonderful lecture, sir. Means
Thank you,
hats
sir.
off in such a lucid manner when the things are explained. I think I also learned many things from a very newer perspective, and there was things which we were aware, but the way in which it was put forward, I think the students must have really enjoyed this whole process, this whole lecture, and yes, they can definitely now attempt those questions. Students attempting a question is just an academic part of the whole journey. What I presume is the level of understanding which sir has given, the level of knowledge which sir has imparted, the level in which you can analyze a particular balance sheet, you can have a different dimension from going forward from today onwards, actually, and try to implement this in all walks of your life. Try to see new and new balance sheets. Try to ensure that you are fully conversant with these various terminologies and use it in your day-to-day life. Sir, really, it was a wonderful lecture. I think this is just a beginning, sir. We would like to have you for many more such occasions where you can guide our students and they can definitely gain insight into the various aspects. And thank you so much, sir. Uh, for a formal vote of thanks, I would like to invite Madhura madam. And sir, if the student desires to contact you, we'll also provide them with your contact number, contact details, so that we can have a word with you in case of any difficulties. Thank you so much, sir. I invite Madhura madam to just deliver a formal vote of thanks.
Yes, thank you, sir. And thank you, Nikhil Karkhane, sir, for this wonderful session. The concepts were explained in such a simple manner. Like management accounting is bit tricky to understand at times, but you really made it easy for our students to understand. At this point, I would like to thank the principal of our college, the vice principal, the head of the department, Professor Yogesh Prasade sir, for organizing this lecture and having a wonderful speaker for this session. I would also thank all our department members in making this session successful, as well as the technical team for making this a YouTube session, a YouTube live, as well as Zoom session. So ideally here we end our lecture for today. The link will be shared over your...
Great opportunity. I felt very nice interaction. Thank you.
Sir, at this juncture, we usually call for some tea party or snack party. But this being a virtual lecture,
I will be very happy to come to college, madam, anytime.
Yes.
Definitely, sir. You're most welcome anytime. You can visit, and जो आज का pending snack party we can definitely enjoy then. So thank you, sir. Thank you.
Thank you, Prasade sir.
It was a great pleasure, sir. Thank you,
sir. I will take your leave here.
Yes, sir. Yes, sir. Thank you.
Yes, sir. So recording has been stopped. So students, the link for this today's session, the quiz or relating to today's guest lecture, the link will be shared over your WhatsApp group. And Please attempt it. You have about 30 minutes of time to complete the quiz. Okay. Over to WhatsApp for the link of